Yeah, so I think we have seen a correction in the public market as a result of some of the frankly inflated valuations that emerged around the pandemic. And I think we're seeing a correction on valuation multiples come down, frankly, to more historic norm kind of levels. And obviously, I can't possibly guess, where the market goes from here. But I do think that it's healthy to come back to, earth a little bit in terms of how we value these companies. That obviously, in turn, is then rippling into the private market, where we're then seeing valuations, begin to get affected in the private sector as well, or the private market as well. But I think, a lot of this is more, normalizing to historic levels and more kind of reversing from some of the more inflated valuations that we saw throughout the pandemic.
It's interesting. I mean, we've obviously had a valuation adjustment, but it does feel as though we've also had a structural change in what investors expect from businesses. And so many companies have seen their share price down 70, 80, 90%. Is this beginning to look more like the 2000 wipeout that we saw for some business models that were clearly just moonshots?
It's interesting. I think we're always trying to find like the perfect analogy, from a historical standpoint. But, in this case, you have companies that I'm mostly referring to the public companies right now that are generating, significant amounts of revenue with significant growth. But the market has sort of said, okay, well, we don't want to pay 20 or 30 or 50x what that revenue is from a valuation multiple standpoint. We want to pay 5 or 10x, which is more that historical normal level. Now, there's another element, which is investors are also saying we'd like to see some profit and we want to better understand the long-term bottom line dynamics of these businesses, which again, I think is frankly healthy for the market. So I think it's a little bit different from the 2000s where you fundamentally usually had companies that weren't generating a lot of revenue and certainly could never be profitable based on the business models that they had. These are, usually much stronger businesses, but maybe that had inflated valuations in some cases.
Aaron, what about the private market? And what are you hearing or seeing in terms of Silicon Valley and an appetite among venture capitalists, which have obviously fueled a huge amount of the investment and in turn the boom in technology? What is your sense in terms of financial conditions and the easiness of securing money right now in Silicon Valley?
Yeah, well, it's interesting. There's two dynamics, right? Because you have a lot of funds that were raised by venture capitalists from LPs during the kind of boom cycle. So there's actually a lot of dry powder in the ecosystem to be able to go toward private investment. So on one hand, you have a lot of capital. On the other hand, you actually have maybe less of a need for all of that capital in terms of, the average investment is likely going to come down because the revenue multiple and the valuation will come down. So less money will be deployed in some of these companies. So it's probably still a great time to be investing in private companies. You just have a lower valuation environment. And I think it's as good of a time as ever to be building software to solve really important problems for people and businesses. So I don't think any of these factors have changed. I think the idea that investors are going to pay, again, 20 or 30 or 50 times revenue for a company, that is what is likely gone, for quite some time.